I need you to look at something that just happened in the silver market, something that technical traders wait years to see. And when it finally appears, fortunes get made. We're talking about a golden cross on the weekly chart. Not the daily, the weekly. And if you understand what that means, you know why I'm recording this right now instead of waiting until tomorrow. Let me paint the picture for you. Silver just closed the week with its 50-week moving average crossing above its 200-week moving average. This is the kind of signal that doesn't happen often. The last time we saw this exact setup was back in 2010. You know what happened next? Silver went from $18 to $49 in less than a year. That's a 172% move. Before that, 2003. Silver was trading at $4.50. Within 8 years, it hit $49. That's a 988% gain. Now, I'm not saying history repeats exactly, but I am saying that when this signal appears, something significant tends to follow. And right now, we're sitting at a moment where the technical setup is screaming one thing, while most retail investors are completely asleep at the wheel. Here's what makes this different from your typical technical indicator. A golden cross on a weekly chart isn't some day trader's fantasy. It's a long-term trend confirmation that institutional money pays attention to. These are the signals that pension funds, hedge funds, and family offices use to allocate serious capital. We're talking hundreds of millions of dollars moving based on this exact pattern. And it's not just the golden cross. Look at what's happening underneath the surface. Silver's been building a base for 3 years. 3 years of consolidation between $22 and $26. That's not weakness, that's accumulation. That's smart money quietly building positions while everyone else is distracted by the latest crypto pump or tech stock rally. You want to know who's been buying during this consolidation? Central banks. Not directly in silver, but they've been hoarding gold at record pace, and silver always follows gold. It's the little brother that gets ignored until suddenly it's not. The gold to silver ratio right now is sitting around 88-1. Historically, that ratio averages 60-1. When it reverts to the mean, and it always does, silver doesn't just catch up, it overshoots. Let me tell you about what happened in 2011. I watched this unfold in real time. Gold was making new highs, everyone was talking about it, and silver was quietly sitting at $26. Then, something shifted. The ratio started compressing. Within 4 months, silver hit $49 while gold went to $1,900. Silver outperformed gold by a factor of 3. The people who understood this relationship made generational wealth. Right now, we're set up for the exact same dynamic. Gold just broke through $2,700 and is consolidating near all-time highs. Silver is still 50% below its 2011 peak. That gap doesn't stay open forever. When silver starts moving, it moves fast and it moves violently. But here's what most people miss. This isn't just about technical patterns or historical ratios. There's a fundamental story unfolding that makes this setup even more compelling. The supply-demand dynamics in silver have completely changed over the last decade. Industrial demand for silver is at all-time highs. Solar panels alone are consuming over 200 million ounces per year. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure, medical devices, water purification, electronics. Every major technological trend of the next decade requires silver. And unlike gold, which mostly sits in vaults, silver gets consumed. It's used up. Gone. Here's the problem. Mine supply peaked in 2016. We're producing less silver today than we were 8 years ago. Meanwhile, demand keeps climbing. The deficit between what we're mining and what we're using is being filled by above-ground stockpiles. And those stockpiles are shrinking fast. The Silver Institute just released their latest report. We're looking at a supply deficit of over 200 million ounces this year. That's the 5th consecutive year of deficits. You can't run deficits forever. Eventually, the market has to reprice to incentivize more production or ration demand. That repricing is what we're about to witness. And then there's the paper market. This is where it gets really interesting. The COMEX, where silver futures trade, has a fascinating relationship with physical silver. On any given day, there might be 200 ounces of paper silver claims for every ounce of physical silver in the warehouse. It's a fractional reserve system, just like banking. And just like banking, It works fine until everyone wants their metal at the same time. We're starting to see stress in that system. Delivery requests are up. Warehouse stocks are down. The spread between paper prices and physical prices is widening. When that spread gets wide enough, arbitrage kicks in. People start standing for delivery, draining the warehouses, and suddenly the paper market loses its ability to suppress prices. I want you to think about what happened with nickel in 2022. The London Metal Exchange had to halt trading because a short squeeze got so violent it threatened to bankrupt the entire exchange. Nickel went from $20,000 a ton to $100,000 a ton in 48 hours. That's what happens when paper markets meet physical reality. Silver's setup is even more extreme than nickel was. The short positions are massive. The physical market is tight. And now we have a technical signal telling us the trend has shifted. This is the kind of environment where short squeezes don't just happen. They become legendary. Let me tell you about the Hunt brothers. Back in 1980, they tried to corner the silver market. They accumulated over 100 million ounces of physical silver and pushed the price from $6 to $49 in less than a year. The establishment freaked out. They changed the rules mid-game, raised margin requirements, and crushed the Hunt brothers. But here's what's important. It took just two brothers with a few $billion to move silver from $6 to $49. Today, there are thousands of hedge funds, millions of retail investors, and a growing awareness that precious metals are the ultimate inflation hedge. You don't need a conspiracy to corner the market. You just need enough people waking up to the same reality at the same time. And that golden cross we just printed? That's the wake-up call. Now, I know some of you are sitting on retirement accounts, watching your purchasing power erode, wondering what to do. The traditional 60-40 portfolio isn't working anymore. Bonds are getting destroyed by inflation. Stocks are overvalued by every historical metric. Real estate is priced for perfection. Where do you go when everything's expensive? Quick aside here. If you've got $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. Shows you exactly how to get physical precious metals into your retirement account without triggering taxes or penalties. Worth looking at if you're thinking about diversification. No pressure, just information. Anyway, back to why this matters right now. The macro environment is setting up perfectly for precious metals. We've got $35 trillion in U.S. debt. We've got deficit spending that shows no signs of slowing down regardless of who's in office. We've got a Federal Reserve that's trapped between inflation and recession. Every path forward involves currency debasement. And it's not just the U.S. Look at what's happening globally. The BRICS nations are actively working to reduce dollar dependence. They're settling trade in local currencies. They're accumulating gold. China just reported their 18th consecutive month of gold purchases. Russia's been buying. India's been buying. These aren't small players. These are countries representing half the world's population, making a strategic decision to move away from dollar-denominated assets. When central banks buy gold, they're making a statement about the future of fiat currency. And when gold moves, silver follows with leverage. That's the trade. That's the opportunity. Let me show you what the chart is really telling us. That golden cross isn't happening in isolation. We've got a cup and handle pattern forming on the monthly chart. The cup took 3 years to form. The handle is forming right now. The breakout level is $32. Once we clear that level with conviction, there's nothing but air until $50. And here's the thing about breakouts from multi-year consolidation patterns. They don't trickle higher, they explode. The energy that builds up during those years of sideways movement gets released all at once. We saw it in 2010. We saw it in 2020, when silver went from $12 to $30 in 4 months. We're about to see it again. The options market is starting to price this in. Call volume on silver has been surging. Open interest in out-of-the-money calls is at levels we haven't seen since early 2021. Smart money is positioning for a big move. They're buying lottery tickets because they understand the risk-reward is asymmetric. You risk a little to make a lot. But it's not just speculators. Look at what the mining companies are doing. Silver miners have been consolidating. Mergers and acquisitions are picking up. That's what happens at the bottom of cycles. Companies with strong balance sheets buy distressed assets on the cheap. They're preparing for the next bull market. They know something's coming. First Majestic just reported their quarterly results. Production costs are around $15 per ounce all in. Silver's trading at $31. That's a healthy margin. But if silver goes to $50, those margins explode. A mining company that's making $16 per ounce suddenly makes $35 per ounce. Earnings don't double, they triple or quadruple. That's the leverage in mining stocks. And we're not just talking about the majors, the junior miners, the exploration companies. They're the real leverage play. When silver moves, these stocks don't go up 100%. They go up 500%, 1,000%, sometimes more. I watched it happen in 2010. Companies that were trading at 20 cents went to $3. That's a 15-bagger. Life-changing money for people who positioned early. But you've got to understand the risk. Junior miners are volatile. Most of them will fail. You're not buying these for your retirement account. You're buying them with money you can afford to lose, hoping to catch the one that becomes the next big discovery. It's venture capital in the mining space. The safer play is physical metal or the big ETFs. SLV, PSLV, these give you exposure without the company-specific risk. You're just betting on the price of silver. And right now, with this technical setup, that bet looks really good. Let me tell you what I'm watching for next. We need to see silver break above $32 and hold it. That's the key level. Once we're above $32, the next stop is $35, then $40. After $40, we're in price discovery mode because we haven't been there since 2011. That's when things get really interesting. The other thing I'm watching is the gold to silver ratio. Right now it's 88. When it drops below 80, that's confirmation that silver is outperforming. When it gets to 70, we're in full bull market mode. And if it drops below 60, we're in mania territory. That's when your neighbor who's never bought an ounce of silver in his life starts asking you how to buy it. That's the cycle. It always ends in mania. The question is whether you're positioned before the mania starts, or whether you're buying at the top because everyone's talking about it. Right now, nobody's talking about silver. That's exactly when you want to be buying. I've been in this market long enough to see multiple cycles. I've seen the euphoria, and I've seen the crashes. The pattern is always the same. Long periods of boredom, followed by short periods of extreme excitement. We're coming out of the boredom phase. The golden cross is the signal. The fundamentals are the fuel. The macro environment is the catalyst. Think about what's happening in the world right now. We've got geopolitical tensions at levels we haven't seen in decades. We've got a banking system that required a massive bailout just last year. We've got commercial real estate imploding. We've got consumer debt at all-time highs. We've got a stock market that's completely disconnected from economic reality. When things break, and they will break, where does money go? It goes to safety. It goes to assets that can't be printed. It goes to gold and silver. That's not speculation, that's history. Every major crisis in the last century has seen precious metals outperform. And here's what makes this cycle different. We've got an entire generation that's never experienced a real precious metals bull market. Millennials and Gen Z have only known stocks going up and crypto volatility. They've never seen what happens when silver goes parabolic. They're about to get an education. The wealth transfer that's coming is going to be massive. People who understand hard assets are going to do extremely well. People who are all in on paper assets are going to learn a painful lesson about counterparty risk and currency debasement. I'm not saying sell everything and buy silver. I'm saying pay attention to what the market is telling you. A golden cross on the weekly chart is not noise, it's a signal. Combined with the fundamentals, the supply-demand dynamics, the macro environment, and the technical setup, this is as good as it gets for a trade. The risk-reward right now is extraordinary. Silver could pull back to $28, and the setup is still intact. But if it breaks out above $32, we're off to the races. You're risking $3 to make potentially $20 or more. Show me another asset class with that kind of asymmetry right now. This is the opportunity. This is the moment that traders dream about. When all the pieces align. When the chart confirms what the fundamentals are screaming. When the macro backdrop supports the thesis. When sentiment is still skeptical enough that you're not buying at the top. The golden cross just printed. The signal is live. What you do with that information is up to you. But don't say you weren't warned when silver is trading at $50 and everyone's wondering how they missed it. The answer is simple. They weren't paying attention when it mattered. This is your moment. This is the setup. The question is whether you're going to act on it or watch from the sidelines. Because I can tell you from experience, the people who make real money in these markets are the ones who position before the crowd shows up. And right now, the crowd is nowhere to be seen. That's exactly where you want to be.